Picture a stray dog sprinting furiously down a street, chasing a passing car. The car reaches the end of the block and slows down. The dog finally catches up to the bumper and completely freezes. It has no idea what to do next. Today's retail investors behave exactly like that dog. They log on to shiny finance apps, treating the stock market like an amusement park, aggressively chasing the thrill of buying an asset. Often, they buy simply because they see big institutional players doing it. If news breaks that central banks are hoarding gold, retail investors scramble to buy gold too, completely blind to the actual strategy behind the headlines. Because they enter these trades without a defined exit strategy, they end up trapped and crushed the moment market cycles turn against them. To survive, you have to stop chasing moving targets and adopt the chronological, step-by-step discipline of an 80,000 crow fund manager. Institutions don't invest out of fear of missing out. They deploy capital with strict defensive purpose. Central banks, for example, aren't buying up massive vaults of gold because they expect high returns. They are doing it to de-dollarize and protect themselves against currency depreciation. For a retail investor, this foundation starts with 40% in equities. This is your growth engine, taking high risks for long-term wealth. To balance that risk, add 20% in bonds. These are shock absorbers, providing stability when equities wobble. This chart shows the sharp market crash of March 2020. While the equity line plummets, your bond allocation acts as insurance, preventing your entire net worth from deep diving into the red during these sudden panics. The next 20% goes into commodities, like oil or metals, often held through commodity stocks. These serve as a tactical hedge, protecting the purchasing power of your domestic currency if the rupee begins to depreciate. You complete the model with a final 20% dedicated strictly to precious metals. These are your low correlation assets, an insurance policy that often moves independently from the rest of the stock market. By locking in this rigid 40-20-20-20 split, covering growth, stability, currency protection, and insurance, every invested rupee has a specific job to do before you ever execute a single trade. But even with a perfect setup, a mid-trade crisis is inevitable. Imagine you buy a share at 100 rupees, and it suddenly drops to 60. This is where the amateur freezes. They sit there, gripping onto the falling asset in the dark, praying for the price to climb back up to their original buy-in so they can break even. To break that paralysis, professional fund managers enforce a strict mental rule. You must ruthlessly separate your selling decision from your buying decision. The math is cold. Your original 100 rupees is a sunk cost. You only hold a 60 rupee stock. If another asset has a higher probability of doubling to 120, you cut losses and switch capital immediately. Carrying the psychological baggage of what you originally paid blinds you to current market realities, leaving your capital permanently trapped in dead assets. This brings us to the final challenge of investing, knowing exactly when to walk away. You solve this on day one using goal-based investing. Before you put a single rupee into the market, you tie that capital to a real-world, future-inflated cost, like paying for college tuition or buying a car. For rallied assets, apply the rule of 72. Divide 72 by a 4-year timeline, targeting an 18% return to double your money. For battered assets, use the rule of 110. Divide 110 by 3 years, targeting a 33% return to triple your capital. The second your target math is hit, you exit completely. You ignore the pundits claiming the asset has room to run. The goal is achieved. By setting hard mathematical guardrails before you even enter a trade, you strip the emotion out of the process. You dictate exactly how the ride ends.